You're listening to the What's Happening podcast with Gary Watts.
Good morning, everybody. I'm here with Pete Johnson with Green State Credit Union. Pete, good morning.
Morning.
How are you?
Good to be here.
And if you don't know it, Pete's the premier residential lender in the Johnson County area, does a ton of business, and I'm excited to have you here.
Yeah, glad to be here.
So as we get started this morning, tell us a little bit about your journey, where you went to school, high school, college, how you met your lovely wife, your family. If you want to just kind of take us to the process, I'm always curious to know how people, you got into the lending business, where you're from, and so kind of take us through your prior life here. Before you got into lending.
Yeah, I was trying to think about this. I'm turning 45 this year, and I'm just trying to kind of just thinking about, all this stuff and how I got to 45 so quickly is unbelievable.
I don't see any glasses, so you still must be doing pretty good.
I've gotten the prescription for the glasses. I just haven't picked them up yet. I'm like in denial. I just don't want to do it. It's another accessory I got to wear. So anyway, no, I was born in Des Moines, so originally kind of from central Iowa, born in Des Moines, and then
what high school?
Lived there. I was a Bondurant for our high school. My parents actually moved. I lived in Des Moines only for maybe a few months before my parents moved to Bondurant, Iowa, the bustling metropolis of Bondurant, which is
growing now.
It is, yeah. It's kind of becoming a suburb of Des Moines, really, is what it is. But lived in Des Moines, moved to Bondurant. My dad, was an architectural engineering major. Got a degree from Iowa State as architectural engineering, and so he had just started a company, Design Contractors. And my mom got a degree from Drake in human resources management, and so moved from Des Moines to an old farmhouse, about a farmhouse built in 1897. Bought it from a farmer on contract for like $35,000, and this place, to say it needed a renovation was an understatement of the year. But moved into that house. My dad wanted to renovate it. Always wanted to live out in the country. It's about a 5-acre property, kind of out in the country, just near Bondurant. There, about 5 minutes from Bondurant proper, I should say. And then basically lived there my whole life, remodeling that house. My dad, is kind of famous for starting things but not finishing them. And so I lived, I think, with plywood floors for most of my life. I think the place almost still had plywood floors by the time I left it. So went to Bondurant for our little high school there. At the time was little. It's actually getting really big now. But went to Bondurant for our high school, played football there before graduating, and then moved on to Ankeny. Had a job in Ankeny, worked in Ankeny. Went to DMAC, didn't really know what I wanted to do. So went to DMAC for the first couple of years and just kind of took gen ed classes until I kind of had it figured out. And then eventually moved to Iowa. Knew I was going to go to Iowa eventually. Always a Hawkeye. Grew up watching Hawkeye games. Always wanted to go to Iowa. And I knew I was going to end up there at some point. I just didn't know when, so... Yeah, it's kind of how I got started. I got a sister, lives in Denver. She's about 3 years younger than me as well. So
you came to Iowa. What'd you major in?
I was at first I didn't know. I was really into history. I still am. Super into history. These podcasts. I love this format. I got a history podcast, pretty much playing in my car 24 hours a day. Every time I get into it, listening to one British history podcast, history that doesn't suck. I kind of love anything having to do with history. And I'd taken some history classes at DMAC that I really loved, just some kind of gen ed history classes. And so I knew I wanted to major in history, so I'm double majored in history, political science. Most people think I, got a finance degree or something from Tippy, but I tell them I majored in history and political science, and they're kind of blown away by that. And obviously, the number of jobs in history and political science are few and far between. So that's how I ended up in, finance by accident, so to speak.
And so what year did you get started in finance? And when you first got out, were you in finance?
Yeah, actually, well, it was kind of interesting. It's kind of an interesting track. So I actually didn't know what I wanted to do. So especially after I graduated from college, I've always been really jealous of people that knew. They just had this passion. Like in third grade, they knew they wanted to be a doctor, and now they are. I mean, that's always kind of blown my mind. I always wanted to be that person. I just never was. I don't think I still am, actually, but I'd actually moved from Ankeny, where I was kind of working and going to school there at DMAC. Went to Iowa. A good buddy of mine, Mark Paterno, who works over at Urban Acres, is a realtor over at Urban Acres now. But we became really, really close friends in my first year of college. And he had been doing a study abroad in Spain rather, and had seen all these kind of food trucks that he really kind of liked, and thought that would be really good in the Ped Mall in Iowa City. And at the time, there was only one food truck in Iowa City. That was George's Best Gyros. And he had the crazy idea to start these food trucks. And so, I kind of thought it was a great idea too. My dad was really good woodworker, phenomenal woodworker. And I kind of ran the idea past him thinking he'd probably laugh me out of the room. And he thought it was a great idea. So my partner and I actually started Marco's Grilled Cheese, which is downtown in the Penn Mall, still is. It's actually got 3 shops, brick and mortar shops now that just opened. So I did that during college. So all through college, I was taking 16 to 18 hours of classes and then running a business at the same time, and that kind of grew. We ended up buying out our competitor, George, a few years later. Opened another cart, so we had about, I think, 5 of them at the time, and started doing caterings, kind of expanding out into that, and then kind of got the entrepreneurship bug and started expanding into all kinds of crazy stuff I never thought we would expand into. We started buying taxi cab companies, gas stations, kind of you name it. We owned a gold buying business at one point in time,
Really?
and did all this stuff kind of as I was going into college, and then just after I got out, and so we kind of did that crazy stuff all the way through college. And then after I graduated from college, I didn't know exactly what I wanted to do. With the businesses were going well, but they kind of weren't making enough money to pay all the bills necessarily. We kind of had some ideas for taking those businesses and running with them and franchising them. That's kind of what we were doing, but at the same time, kind of got into real estate by accident, just to pay the bills for the most part. My buddy Mark had become a realtor at Coldwell Banker when he, I think it was Ambrose and Boyd, maybe I can't remember which, but had become a realtor right out of college, and he was a few years ahead of me. And so that was his gig that was kind of helping to pay the bills along with the businesses that we ran. And then when I graduated from college, I kind of needed something along the same lines, and he was already in real estate, so he kind of introduced me to some mortgage brokers that around town that he was doing some business with, referring some business to. And so I kind of fell into it by accident, just out of needing a job for the most part. So
What attracted you to the lending business?
Nothing. I don't think anybody in third grade raises their hand. Nobody in third grade, when they asked, "What do you want to do for a living?" Not a single mortgage loan officer raised their hand.
You don't see that. Yeah. You don't see real estate developers. Either,
That's right. That's right. I wanted to be an astronaut, and that was my game plan. And an astronaut failed, and I didn't really have a backup plan. So in hindsight, I probably should have had a backup plan. But it was really just by coincidence. I just kind of met some people, got to talking to the owner of the brokerage at the time. It was American Residential Mortgage. I had no idea what I was doing. Never sold anything. Didn't know anything about sales. Really didn't know much about finance. I'd taken some finance classes and entrepreneurship classes in college, but other than that, I didn't really have an inkling of what I was doing. And so this was back, I think 2000 would have been 2003. So I've been in this business about 20 years now. But kind of fell into it by accident, and fortunately was able to get a chance to work, work at that brokerage for about a year or so, and realized that finance was really hard. It was really hard kind of breaking in, especially when you're young and you're new. It's really hard kind of getting into this business and kind of getting started. But
what were you doing then? Chasing realtors?
Yeah, at the time, yeah. I mean, just trying to get in. I was very lucky because I had my buddy Mark, and he was already kind of networked with quite a few realtors, and so I was already kind of hanging out with a lot of these people. But it was really hard. I found out in this market, especially in Johnson County, realtors are very loyal, to their people and to the people that they work with. They've got their guy, right? And I was just kind of some young, dumb kid that, didn't know much, hadn't been in the business that long. Nobody knew who I was. And so trying to break in, to some of these higher producing realtors, get them to trust me, to work with me, with some of their clients was really, really, really tough. And, I think the first year that I worked in that business, I was handed a computer basically and a stack of business cards. And I think I went to a seminar. I think my boss at the time that hired me paid $150 to go to a seminar at the Iowa Mortgage Association to kind of learn lending. And that's how I learned. Unfortunately, there were some really great loan officers that were there that kind of took me under their wing and sort of showed me how to present information, how to work all the technology, what all the terms meant. But it was really kind of just thrown into the fire. I think I made $12,000 my first year, and that was working my other businesses at the same time, and then doing that, sometimes 8 to 10 hours a day, just trying to get a foot in the door.
So to the listenership, do you think it helped? You went to school, you just didn't sit around and party. You had businesses.
Yep.
So you're hustling those businesses, then you start into lending. Did that work ethic help you with your career path as you look back?
Yeah, I think that is a major difference. I think, when you're when you own businesses, it's kind of it's sort of a terrifying thing. It's super exciting, but it's also terrifying. I remember when we brought one of our food truck carts out the first night, and the paint was literally drying on the thing as we're dragging it out there. And I think I tripped on the tongue of the trailer and like cracked my knee. On the first day, I'm bleeding, and we're taking this cart out, and you don't know how people are going to react. They're going to be, are they going to think it's a great idea, or are they going to just laugh you out of the street? And so super nerve wracking. Plus, we got a lot of money at stake at the time. We were broke, and so I had to take a loan. No bank would give us any money, so we had to take a loan from my parents. So we were, not super in debt, but for us, we thought, at 19 years old, super in debt, $10, $12, $13,000. My parents lent us, I think they've charged us like 8% interest too. So, but everything's at stake. It's all on you. There's nobody backstopping you. There's no net, right? And so
Nowhere to hide.
Yeah, and so it's the fear of failure. I think just you want to succeed. You don't want to fail. You don't want to be embarrassed. But also there's a financial burden there, and you got bills to pay. You're also doing other things. You got classes, and so you really have no choice. It's not kind of like a 9-to-5 job where you've got a boss that says you got to check, clock in the morning and then you clock out at night and you're done. You're kind of working, and that's a lot how the lending industry is. Like a lot of people think I go to work and I've got a salary, and I love it when people tell me, so you're working banker's hours, banker's hours. And I think a lot of people have this image of bankers and mortgage lenders kind of working these 9-to-5 jobs where they're getting good salaries. They clock out and go home at night, but we're 100% commission. So we're not just like realtors. We don't make any money unless deals close, and so that work ethic, I think, definitely kind of shaped how I do it. And that was probably the only reason I've survived in the business, to be honest.
I always got a kick out of, I've been in real estate a long time, and people really don't know how you get paid. And they don't understand the 100% commission concept.
Right.
And that's how, obviously, you're an entrepreneur. That's how you learn to work. I mean, if you don't know how to work, you're not going to survive in a 100% commission environment. So tell me, as we get going here in the lending, tell me about your family, your wife, and your children. And
yeah, I've got.
When you got married?
Yeah, I got 2 daughters. We actually just celebrated our 15-year anniversary, so managed to get her to stay with me that long.
Right.
Especially in this business is hard. And I've got two daughters, Audrey and Nora, so 7 and 11. So we're going into 6th grade, and my youngest one's out here playing iPad, and she is going into 2nd grade. So yeah,
good. So your first night at Marcos, how well did you guys do?
I think we made $300, and we were ecstatic. I mean, it was like we won the lottery. It was like, I can't believe that people paid. We sell grilled, for those who don't know, we paid, sell grilled cheese, quesadillas, those kinds of things. And we just worked our butts off. We were out there for like 6 or 7 hours, all night, into the bar rush. And it was an awesome thrill to see that people actually came up and their reaction was positive. It was just, like a huge relief. And we thought we were going to be rich. And we were like, this is the end. We're done. We could probably just quit college and be done with it, And,
I bet you got some stories after the bars closed down.
Oh, God, endless stories. Yeah, it's just absolutely nuts. Endless stories. But, yeah.
So now you're in lending. Was it American Mortgage?
American Residential Mortgage. Yeah, it was a broker shop. That. Yeah, they were here not too long. Guy that owned it was from Colorado, and it was kind of at the subprime. The .com bust had just happened back in like 2000, I think, and so rates were super high. But I didn't know any different. Rates were 6 and 7% then too. I didn't know any different. The subprime market was just starting to take off. I never did much subprime. I didn't really have any clients. I didn't even really have an opportunity to do subprime because I didn't really have any clients at the time. But that was kind of going up, and mortgage shops were opening up right and left. The joke that we had back then was if you could fog a mirror, you could work as a mortgage lender at the time.
They say the same thing about real estate.
Yeah,
I've heard that my whole life.
Yeah,
So you're a residential lender, right?
Yep.
So
just
where did you go from American Mortgage? What was your next?
Yeah, it's funny because I got recruited by a really good, recruited, I should say. It's funny, I was using the Marcos carts, the grilled cheese carts to kind of market with the realtors. So I would go and do lunches, basically doing any kind of thing I could to just kind of get some attention and get some momentum going. So I'd do lunch, and I remember I walked set up a lunch with Coldwell Banker. So I brought the card out. I had my little sign up there, my card's on the counter, and I was just talking to the agents, doing lunch for them, catering a lunch in. And Art Floss, one of my good friends now, mentors, worked over at Wells Fargo at the time, and he was doing a ton of volume at the time. He was kind of the big shot mortgage lender in town. And he rolls up, didn't see me. He's blind. If you don't know Art, he's actually legally blind, but didn't really see who I was or that I was running. I was working for a brokerage at the time, and And he kind of slaps $100 bill on the table. And he's like, "I'll get lunch for everybody." I was just like, I just wanted to like strangle it. I'm like, "Are you kidding me?" And his assistant kind of like nudges him. He's like, "Hey, Art, he's a mortgage lender." And he's like, "Oh, I'm sorry," But I think he was kind of impressed that I was doing that. Because a lot of lenders don't kind of do those things and are afraid to do those things, but they're kind of getting out there. And so he kind of noticed me, and then we kind of became friends. And then he tried to recruit me over to Wells Fargo, and the brokerage was great. I mean, it was a great opportunity, but it was really hard. I mean, when you're new and you're young and you're at a lesser known place, it's even harder. And so I knew that I'd be a little bit more well known if I was with Art over at Wells Fargo, and Wells Fargo was doing a lot more volume than this brokerage was at the time. And so I moved over with him. And this is at a time when, mortgage companies were writing checks like bonuses just to come over. They just needed bodies, to fill seats. And so I came over and worked with him. And then I think we were there all of a year, before we got recruited by Countrywide on the A-paper side. And I say A-paper, I say prime. We weren't doing subprime. But
what's subprime?
Subprime, yeah. Subprime. So back then, it was basically kind of, I hate to say like anything goes lending, but really low credit scores, high loan to values, very little money down. You could get a loan. And the guidelines back then were very loose. As everybody knows, the 2008 mortgage crisis wasn't a good thing, and it was kind of caused by subprime for the most part. But there were two sides that you could go on. You kind of had to choose. You could work both, but it was hard. And you kind of had to choose A-paper versus subprime. A-paper, we call A-paper is kind of conventional fixed rate financing, where the rules are a lot harder, a lot stricter, a little bit harder to get deals done, but the credit scores are usually higher, and it's the type of loan that we do today. Basically, we call it A-paper now. A-paper is the only thing that really exists now. And so I had a choice there at Wells Fargo. I actually met with both. I met with the subprime person, and Art was my manager on the A-paper side. And in my head, I just knew that this subprime thing probably wasn't going anywhere, and it wasn't the place to be. And so I wanted to be with the higher credit people doing the right thing. And so that's what I chose. I chose the A-paper side with Art, which was going to be harder. I was going to make less money because the subprime business was more profitable, but I just kind of knew that was probably not a place to be.
So you've seen the show The Big Short.
Oh,
right?
I love The Big Short. Read the book too. Love Michael Lewis. He's amazing.
He's playing the drums when he's
Yeah.
But obviously, people have to understand this. So you're basically loaning people that really couldn't afford it, and they were low credit, or they had credit that was not real
high credit risk. Yeah.
And all of a sudden, the property values were going up, and then all of a sudden they stopped going up, and then everybody's stuck.
Yeah, big game of musical chairs. Yeah.
And that's what happened in 7, 8, 9.
Yeah.
That caused a lot of grief in the economy and in the nation, and interest rates, everything went bananas then. So
yeah.
You chose the right path to stay on the good credit, folks. So
yeah, and I would say at the time I didn't really know any better. I mean, I was too young and stupid to really know that. I just thought smarter people than me have figured this out, and if this product's available, why they wouldn't do it if it was failing, right? Now, banks aren't in it to fail,
Right.
To go foreclosures are not good for anybody, including banks. But I just didn't know. But I just kind of knew enough to know that this is probably not where I want to be long term.
So let's talk about banks to mortgage brokers. I remember a bank when I was a kid. I'd mow a yard. I think I was getting $1.25 for mowing a yard. And my mom would take it with me, a little passbook savings book.
Yep.
And I take it to the Oskaloosa Savings and Loan, and be a little stamp, and I put my $1.25 in this little book.
Right.
That's what I thought a bank was. That was a savings loan, actually, but a bank. So when you think of a bank, you think of bricks and mortar. You think about walking in and getting a loan. So tell us a little bit about the difference between, in essence, a bank and a mortgage lender.
Yeah, banks. So, there's kind of three types. I work at a credit union. So, a mortgage broker is basically an independent shop that usually just does mortgages. So they originate loans. That's what a lot of people don't really kind of know, is that the bank, credit union, or mortgage broker that does your loan is generally not holding your loan. Most banks, brokerages, especially if they're smaller or medium-sized banks, brokerages, or credit unions, don't have enough cash to handle the kinds of volumes that we're lending out. Hundreds of millions of dollars in our case, billions actually, in every year in mortgage lending. We'd run out of money very quickly. Even the Wells Fargos of the world would run out of money very quickly if they didn't sell the loans on what we call the secondary market. So those loans originate here, they get sold there. And mortgage brokers will generally just originate mortgages. They're not doing checking, savings accounts, stuff like that. They're basically just originating the loan. They're taking all the pay stubs, the W-2s, all that stuff. They're kind of showing you the products, kind of placing you in the product, and then they're generally selling the loan on to the secondary market, an investor that's going to hold the loan. That's where you make your payments.
How did that grow from like so you're in Bondurant for our you go down to the local bank and whatever the savings that came in, they would loan part of that out in home loans.
That's right. Yep.
That's kind of the old days.
Yep.
Kind of like when Jimmy Stewart was on that Wonderful Life.
Yeah.
It's kind of like a savings. That was a building and loan they called
Right.
it. I don't know who was the old guy in the wheelchair that had the bank.
Yeah, I can't remember. Yeah. Yeah.
So anyway, locally you had money that was generated by savings, and you loaned that out.
Yep.
That's changed substantially, like you talk about mortgage brokers, and they're selling the loans.
Yep.
Why? What's going on?
Yeah, you make a profit, and a lot of it's just liquidity. So there's so much volume now. There's so much volume that's moving through the market that it's impossible for any one institution to do the kind of volume. So we're doing more volumes than, the old model of the small town home bank. They might do a handful of loans a year or something like that, and they had the cash for that. Now, everyone's buying a house. The rules for for buying a house are a lot less stringent. It used to be you had to have a lot of money down, and you were maybe further along in you're in age, at least when you bought a house. My grandparents, they bought one house and they died in it. That was it. Yeah. After the war, they got back from the war, and one house, they bought it for probably a sanely low amount of money, and then that's the one they stayed in. But now people move every couple years. I mean, they might move every 4. In Iowa City, I think the average is 6 years, something like that. So there's a lot more volume churning happening right now, and so that's why they have to sell them, is because we just can't hold them that long. And it's a good thing because it provides liquidity. Fannie Mae and Freddie Mac are the two great big huge mortgage giants that back these loans.
Tell them what that means. Fannie Mae and Freddie.
They're basically insuring the loan. So they're basically saying that if the loan goes bad, the Fannie Mae and Freddie Mac will kick in to recover losses. That's why they got a lot of heat, during the 08 crisis, because they were on the hook. They're basically the insurance company, right? But they're a good thing, because without them, we wouldn't have the liquidity in the market that we do now. No one would be able to buy a house. You'd have to essentially wait until the bank had enough cash to go buy a loan. So without the secondary market, without Fannie Mae and Freddie Mac, there wouldn't be the real estate market that we have today. It just wouldn't function.
Tell the folks what Fannie Mae and Freddie Mac stands for, what it means. Federal agency.
Yeah, it's a federal agency that backs all government. Well, I could get into the weeds with this for probably 2 hours. But it's essentially they're just two semi-governmental organizations. They're part private, part governmental. And I don't know the detail. I can't get it too much into the weeds in terms of what Fannie, how they operate specifically on the back end. But that's their job. It's the government providing liquidity, essentially, and regulating the financial markets. So they create all the rules is essentially what they do. Right. So they say if we here's the credit score requirements. Here's how much money you got to have down. How long do you have to be in your job? What documentation is required? And those rules are constantly changing all the time. They changed dramatically after 08 once the mortgage market collapsed. Those rules tightened up very quickly and changed. So that's their function, is to basically make sure that the mortgage industry, the mortgage market, remains liquid.
So more and more people are getting in the housing market. That creates jobs for mortgage brokers. You're selling the loans to the secondary market, which is Fannie and Freddie.
Yep.
Other small banks buy loans, right?
That's right.
Other banks buy loans.
Yep.
And maybe rural areas, they don't have as many home loans.
That's right. Yep.
They have more ag loans or more deposits, and then they buy mortgages.
Yep,
so.
and they'll buy loans from us. So we do keep a lot of loans in-house. So we do keep a pretty sizable chunk. I'm lucky at Green State. We've grown from less than $1 billion in assets just in the time I've been there. I've been there about 13 years. Green State used to be formerly University of Iowa Community Credit Union, but we've grown from a $1 billion bank up to an $11.5 billion bank. We went from, I think, something like under 120 employees to almost 1,000 employees now. And so, the volumes that we're doing are much larger now. But we do keep a significant portion of that in-house. But again, that's really hard. It's really hard right now because our savings rates, interest rates are so high right now on our CDs, things like that. Savings rates are high, which is good for savings, but also bad for loans because we have to try to lend that money out at a much higher rate just to cover our overhead. Has gotten really difficult.
So let's say you're a young couple. Let's say, for example, a young person, you want to get into housing. How do you start? How do you pick a lender? Let's say they call you. What are some things that you want to know and educate them on in the home lending business?
Yeah.
What would you look at? What are the things that you go through? Maybe talk about ratios. Maybe talk about qualifying. Maybe talk about down payment. Because you're right. In the old days, it used to be 25% down.
Right.
And then you usually had one house. You stayed there for 30, 40 years, and you died in that house. Your grandparents in that house. but we're a lot more transient. We're moving around. We have a lot more housing opportunities. So let's just say I'm just starting out, and then why would you use somebody like yourself, and why would you use the local lender?
Right.
I always stress that.
Right.
I always stress to use a local person. But anyway, tell us a little bit about qualifying somebody.
Yeah. I think a couple things there. So, I mean, obviously credit, you want to try to be at least in the high 600s, 700s. Right now, that's going through a lot of change right now too. The higher your credit score, generally, the better off you are. Not always, but generally the better off you are.
Let's take
so
that
credit's
credit
important.
Score. Let's take that credit score. So you never have a second chance to build your credit.
Right.
That's why don't mess it up.
Right.
That's what I tell people. Don't even think about it. But tell us what a credit score is. What are you looking at? And then how can a young person, maybe they're just out of high school, and why not get a credit card and start establishing a credit to yourself and get a credit score? So tell us about credit scores.
Yeah, credit score is essentially just it's really just an indicator of how you paid things back over time. Simply, that's what it is. So it's a tool that lenders will use to be able to verify how you've made payments over time, what kind of loans have you taken out, and how have you paid them back. And so it's super important to have it. And I think the earlier you can get it started, a credit card's a great way to do it. Double-edged sword there, because a lot of young kids, myself included, I mean, I remember them handing out credit card applications in high school and but not really telling you why. They wouldn't really say this is to establish credit. It was more like, here's a credit card, and then we'll send you $1,000 in your pocket to go spend. You're like, yay. But a lot of people get in trouble right off the bat with that, and they're making late payment, whether accidental or on purpose. And then your credit score is kind of tanked right from the start. I see that a lot. So, but getting your credit established early, and I see, a lot of people, it's hard for people to understand because people come in with no credit. They've always paid things on time. They've, always done the right thing. They haven't borrowed a lot of money, but they also have no history. So they have either no credit score, or they have a low credit score. And we always say having no score is as bad as having a bad score for the most part. And that's not because they're saying you're a bad person. And a lot of people take this very personally. But it's not that they're saying you're a bad person, you don't pay your bills back. It's just that they don't have any written history of you ever. There's no recorded history of you ever making payments. So having that credit established, it doesn't need to be much. It can just be a credit card that you use, or maybe you take out a car loan or something like that. You don't have to go wild. Yeah, you can always pay it off. You don't have to go wild. It's really just the usage. They want to see usage over time, and they want to see a history of that.
You pay every month. You're on time.
Yeah. And so there's that. Down payment comes to play. We're kind of fortunate now these days, not like the old days where you had to have 20 or 25% down. You can actually put no money down. We still have 100% financing loans where you actually don't have to put a lot of money down. I see that's the biggest obstacle to younger first-time home buyers is down payment. So there's just not a lot of savings. I think in our society now in general, there's just not, unfortunately, not a lot of savings, not a lot of ability to save like you used to back in the day. And so down payment's important, but you can in some cases get away with very little down. So there's a lot of first-time homebuyer programs, more than there's ever been now, that allow for 3% down. There's a lot of grant programs out there that'll help with down payment. Not a ton of them, and they are income qualified, so not everybody can qualify. But
let's take the down payment. Let's just think about this a second. And this kind of gets more into the real estate side of it. Let's say that you really want to get into a starter home or whatnot. And actually, any more of those are $250,000 around here. I mean, it takes quite a bit to even maybe $300,000 even get into real estate. But let's say you're buying it and you only have maybe 3% down, $10,000 in a $300,000 house or whatever. It's not a lot of money into it. If that house inflates 3% in 1 year, which I think inflation's at 2, 3, 4%.
Right.
And the fun thing about Johnson County, I've been here my whole life. It never really goes down, never really shoots way up fast. It's just steady, just creeps along, which is nice.
Yes.
So let's say it went up 3 or 4%. On $300,000, it's about $12,000, and that's less than what you put down. So if you put down $10,000 and it inflates $10,000, you have 100% return on your money.
Right.
Or if not infinite, because maybe you borrowed a down payment.
Yep.
I think that's where people miss the boat. They think they got to put a lot of cash in it. And if they've got the ability to repay and they've got two incomes and they're really doing it well, which in Johnson County a lot of people do have two incomes.
Right.
Why wouldn't you take advantage of buy real estate? Look what real estate's done over the last 40, 50 years.
Yeah. I mean, that's why they call it one of the greatest wealth builders, right? So owning real estate is one of the greatest things you can do, in my opinion. And assuming that you're going to be here longer term, and if you're going to be here 1 or 2 years, you're probably not going to live there long enough to recoup the cost of selling the home, because you've got a lot of fees. As people don't quite understand, is you got a lot of fees when you go to sell a home. But generally, you want the appreciation to overcome the combination of the appreciation and the money that you're paying the loan down with. to offset that, right? And you should, if you stay there 4 or 5 years, 3 to 5, I'd say at least 3 is kind of my benchmark, but it depends on the house. But yeah, I mean, compared to rent, right, which is just throwing it away. And rents, I mean, I own rental properties too. It's one of the businesses that I still do own, and they aren't getting any lower, and they're high as well. A lot of times higher than what you can do when you buy. Yeah, and I know you had Adam Pretorius on the other day, and he was talking about how nice the Iowa City market is, how kind of nice this stable this market is. You're never going to see appreciation go through the roof like you would in maybe like Las Vegas or New York or Florida.
Phoenix.
Yeah, Phoenix. You wouldn't have these things where the rates go through the roof. It's a part of what made 08 really bad. And I was here in 08 doing this, but they also don't plummet either. I think in 08 we saw we didn't see houses appreciate much in 08, but we also didn't see them collapse.
Right.
Yeah, they didn't really drop, except some of the rural areas, the very rural areas. We didn't have that, and rates dropped at the same time. We just did a tremendous amount of refinancing, putting people in better spots with lower interest rates, which is also what we did in kind of 2020. So
in 8, 9, and 10, we cleaned up a lot of things with the poorer loans, and we got into where we straightened it out. And you had to have more down. You had to be a better credit risk, better credit score. So let's say you got your ducks in a row. You got a good credit score. They come and see you. You talked about down payment. Talk about your ratios. Talk about their incomes. What are you guys looking for when you loan money to folks?
Yeah. So from a debt ratio perspective, the debt ratio is the amount of money that's coming in, your income, your gross income coming in versus what's going out. And so generally speaking, we like to see 43% or less, although there are programs that will go all the way up to like 50% of your gross income. So just to keep the math simple, if you had $1,000 a month coming in, we want to see $430 or less going out. And that's to pay your mortgage payment, your student loans, your car loans, your credit cards, loans, basically. Not to be confused with, utilities and going out to eat and clothing, stuff like that. They figure the rest of that money kind of goes to taxes and some of those other things, right?
How do you look at student loans?
Yeah, student loans. Depends.
Did they forgive all those?
Yeah. I got a lot of people waiting for that to happen.
Yeah,
I don't know that I would count on it, but student loans, a lot of them are deferred. So we've got a lot of programs in-house that we use where we don't actually necessarily have to count student loan debt until it actually kicks in, because we know eventually you're going to go out. Med residents, I do a ton of business with doctors, are probably about 40% of my business, 30-40% of my business. Do a lot of med resident deals where medical residents are coming in with huge amounts of student loan debt, obviously, and they were in med school, so they didn't have a lot of time to save. And so those loans are deferred or in forbearance, and a lot of times you can not count them. If you're doing a standard conventional fixed rate loan, they'll make you use a percentage, usually 0.5% of your loan balance as a monthly payment. So that can impact things, too, especially when you're trying to get standard kind of conventional 30-year fixed rate loans as opposed to the in-house loans, the ones that we keep.
So if somebody comes to you and they haven't been very wise about spending money, and they bought depreciating assets. Real estate's appreciating.
Right.
And I always get a kick out of people. I want to buy a car, I got a boat, I got a motorcycle.
Right.
Well, that stuff's going, as soon as you buy it, it's worth about 20, 30% less.
Are you saying my boat's not going to be worth as much as
I like your boat, though. But anyway, so they do silly things, and all of a sudden now try to get into real estate, but you can still help them. You can consolidate those loans.
Yeah.
Talk a little bit about the total debt and then how you can help them get into a house.
Yeah, so that's part of this job I like the most, probably, is getting somebody, especially the people that are going through divorces, maybe financial distress, or maybe got themselves in some hot water, especially people that are kind of willing to work. You can tell they really want to get things straightened out. Right. I really like doing that stuff. I kind of like consolidating, lowering interest rates on vehicles. That's something we do. We work very closely with our retail side at Green State. I've got a person that works directly with me. It's called a mortgage miner that basically looks at that stuff. And so I'll send them back and forth, try to consolidate things, try to bring those debt ratios down, get you in a better spot. So maybe we're at like a 31% debt ratio, a 35% debt ratio instead of a 43, right? So instead of being right at the max, which is never a great thing. And a lot of times we can get you qualified. You maybe come in not qualified, we can get you qualified. If we can't get you qualified, we don't just leave you for dead, right? So we kind of go over those things and say, hey, this is the path that you need to be on. Here's what we can do. Shuffle these things around. This is how you can get your credit improved. We might refer you over to a credit counseling or credit repair. Try to get you in a spot where we can maybe 6 months, 12 months down the road, we can get you back in, try to get you qualified. Right. So it's never one and done, leave you for dead kind of thing. We're looking towards the future.
We're talking about mortgage brokers and mortgages. Tell the listenership, what is a mortgage?
Mortgage is just it's basically just a promise. Well, I'd say the note is the promise to pay the money back is how I kind of explain it. So when you sign a note, we call it the note. That's the loan. And it basically says, I am borrowing $200,000, right? And I'm agreeing to pay it back. And what the mortgage is a separate document. A lot of people think the mortgage is the actual loan. The mortgage is actually just the security instrument. It basically says, if I don't pay the loan back, the house is what's being used as collateral. The house is what they keep. One of our real estate attorneys has a saying: if you pay, you stay; you don't, you won't. And so that's what the mortgage is saying. You're saying, hey, you understand if you can't pay the mortgage back or don't want to pay the mortgage back, the house is being used as collateral.
It's basically a lane to the bank or to a credit union that says, hey, if you don't pay them, they're going to take your house.
Yeah.
So
Yeah.
It doesn't happen very often. So if you follow any mortgage foreclosures around here, there aren't many.
Right.
There's hardly ever because we have such a great market.
Yeah, our default rate's pretty low at Greenside. I don't know what I hesitate to say what it is now, but it's usually very, very low. Fortunately, especially in Johnson County, we just don't see.
So back to 43%. You got a down payment. You got a decent down payment. Where do you go from there?
Yeah. So yeah, then I think it's getting with an agent. If you're a first-time home buyer, younger first-time home buyer especially, I think it's always good to have an agent. A lot of people don't understand realtors. A lot of people assume that they have to pay the realtor if they're a buyer. You don't. But I think it's good to get with a real estate agent, especially when you're on the buy side and you're new to this process. Because they're going to be able to kind of direct you. We work very closely with our realtor partners. Getting you both pre-qualified. That's what we want to do. We want to get a pre-approval for you. So you've come to the bank. We've kind of checked credit. We've checked those debt ratios. We kind of looked at down payment. We've looked at options, and then we've kind of walked you through the process. This is how it works. I get a lot of people that will come into my office and they're buying a house today. And I'm like, today? I was like, have you talked to a bank? It was like, I got to get, my realtor said I had to get pre-approved. And I'm like, well, that's something you want to do now. Even if you're only thinking about doing it, if you're thinking, I may not buy for a couple of years, you want to get in, probably get pre-approved, figure out where you're at. It doesn't cost you anything. There's no pressure. Nobody's going to pressure you into doing anything you don't want to do. It's mainly just to see where you're at. Right. So get started with that pre-approval, get with that agent, start looking to see what houses are out there that you like. What do you like? And then what's your price range, right? We can help you with what you can afford. And then you want to see if what you can afford is actually realistic for the houses that you're looking at in this market. And if it's not, you can make adjustments. But I can't tell you how many times I have somebody come in and they say, well, I'm not quite ready for the whole pre-approval process. They're kind of intimidated by that. They don't want to pull credit. They think it's going to hurt their credit. It doesn't. That's kind of a myth. And I say, okay, that's fine. No problem. I'll keep my notes on you and we'll talk later. And then, a week later at Friday after I've, poured my first bourbon, I get a phone call saying, I found this house. I got to get pre-approved tonight. Right. Yeah. And so it's better if you kind of have all that out of the way. And I think it's a much more comfortable process, especially in a market that's moving so quick. That's what I feel really bad for first-time home buyers right now, because this market is moving so much faster. When I bought my first house, I had time to think about it. Right. I could sit on. I could look at several different houses. Right. I could go in and negotiate a better price. I could do, and none of that's happening right now. It's really hard.
Let's take the mindset of a buyer. Let's just think about this a second. You said they're a little intimidated to maybe talk to you and pull credit. Right. Think about that. Yeah. I mean, think about what we do, and they're intimidated by that. But now let's take the psyche of a buyer and somebody coming to see you.
Right.
Have they borrowed very much before? No.
Right.
Have they ever bought a home?
Right.
No.
Yep.
It's the largest investment they're probably going to make in their lifetime. Yep. So now get into the psyche of that buyer. That's why they're nervous. That's why because who are they going to go to? That maybe their folks or they got an aunt and uncle that bought a home.
Right, right.
And they're probably not going to ever borrow that kind of money again.
Right, right.
So that's why, I think it's smart to get pre-approved when you're in a relaxed state as opposed to the pressure of the market. Because a lot of things were selling in the past markets for more than full price. You had to be ready to go, and you had to write cash offers.
Right.
You couldn't make it subject to anything, and that really separated the folks and put them in different categories. So it was very difficult to get a piece of property bought, I think.
Right.
So the more you know up front, the better. Mm-hmm. And to know why they're nervous is maybe they bought a car before, but that's nothing. They just hand that out. But a home gets into a lot of different things. Let's take it to the next step. So they've seen you, they made an offer. Tell the listenership, what's an appraisal? Why do you have appraisals on property?
Yeah, appraisal is just to determine the value of the collateral. So we're doing an appraisal to make sure the house is worth what you're paying for it, basically. To make sure that the price that the seller's asking is not so high that you're kind of underwater from a loan to value standpoint. And so the house generally has to qualify. There's two sides of qualification I always tell people. There's you as the borrower, right? You as the person that's borrowing the money to buy the house. You have to qualify, but also the property has to qualify too. So the value has to be there. Because we can only lend you up to maybe 95 or 100% of the home's value. We can't go higher than that, even if the seller wants a higher number. And then also it's to a lesser degree the quality of the condition of the home, just to make sure that the house is in a condition that can be financed, right? So houses that are in the process of like being remodeled, stuff like that are under construction, those are generally going to be trickier. Unusual properties, berm homes, like big acreages, places that have a lot of farm buildings, I call them farmy properties. Are always going to be a little trickier to find comparable sales. And what they're doing is they're just looking to see if the house that you're buying, the price that you're paying for it is comparable. We call it comparables. Compared to other homes like it, is it reasonable? So it's a good thing, and it's a good thing for both the lender that you're working with and also you as the buyer. So.
Do the appraisers or the lenders look at assessed values compared to appraised values?
Not really. From the appraisal side, they probably do a little bit, but for us, no. The assessed values are always a lot lower than the actual market values typically, although in Johnson County here recently, they're starting to come up a little bit, but a little bit closer to the market values. But no, generally the assessed values are going to be a fair amount lower than what you see on the market. And that's a big point of confusion that people have. Is they see the assessed value and they see this price, and they're like, oh my God, why is the seller charging this much? And they're two completely different things.
So if you make an offer on a property and you've been pre-approved, how long does it take to get it process that loan so they can close the house?
Yeah, about 30 days typically. We like to have about 30 days if we can. On rare occasions, we can do it a little bit quicker if need be. We find some kind of emergency situations where we do it sooner. And it could be as far out as 60 or 90 days, 120 days, just depending on when you want to get in, when the seller wants to get out. That's part of that process. And I'd say part of that pre-approval process, I was going to say, we kind of touched on this briefly, why use somebody local versus somebody national. And the local lenders, I think, and this is kind of a point of confusion too, because I think a lot of people, especially moving in from out of town, some of the bigger markets, they kind of think, well, there's this, small credit union or small regional bank or whatever, and then, Chase and Wells Fargo, though, or do the majority of the loans, or the big banks do the majority of the loans. And actually, the overhead there is higher, and rates, fees tend to be a lot higher, not always, but tend to be a lot higher than your local banks and credit unions. And so I always recommend that, and I think the realtors recommend it too, because we have relationships established with those realtors, those agents. They know who we are. We're kind of a known quantity. The local loan officers are kind of a known quantity there. And we generally have programs that if we can't get it to go the secondary market side, the fixed, that conventional fixed rate side where you're selling the loan, which the big banks, that's generally all they do. We have backup options. We have in-house programs. Something goes wrong, we're going to be able to fix it fairly quickly, and our reputation is also at stake. So, like I said earlier, we only get paid on what actually closes. So we have a huge incentive to get you closed and get you closed on time, because we've got relationships with the realtors that we work with and who are a source of our business, the leads that we get. And so we have a huge incentive. The realtor, loan officer locally has a huge incentive to get you to closing on time and get it done the way that it should be done.
Tell us what an in-house mortgage means. When you talked about selling a lot of things, and then you can go at Green State, you can go in-house. Tell us about that.
Yeah. So in-house is nice because it's our money that we're using. So part of that $11.6 billion that I talked about earlier is money we have in-house here at Green State. And so we have the ability to kind of bypass those rules. We can make our own rules. So we've got, specific situations. We're a university town, so we've got a lot of we've got students, professors, a lot of healthcare professionals moving in and out very quickly. And some of those incomes don't qualify. The way that the contracts are set up, if you're a student, it's going to be really hard for you because you don't have any income, but you might have a parent that is willing to kick in. And so we have programs for that where you can buy a house while you're going to school and your parents can pay the mortgage. If you're a med resident, you've got $300,000 in student loans, that's going to disqualify you from pretty much any conventional fixed rate loan because they're going to count those payments against you. That you can do that here. So
condominiums, same thing.
Yeah, new construction condos are really tough to finance. They usually like the condos to be completely turned over and finish the association, and that's usually not the case with new construction condos, and they can take 2 or 3 years before they're completely finished and done building. And so, a lot of the condo business wouldn't happen at all. If it weren't for that in-house lending. So it's very important, and the with the U.S. banks, not to bag on any one large bank here, there's some great people working at those banks too, but Wells Fargo's, the Chases, the Bank of America's of the world. A lot of times if they have that ability, it's very limited. And especially in Iowa City, because it's a unique market, speaking for Johnson County here, it can be really challenging, to do those. I probably 2 or 3 times a year, I have somebody insist that they can do a 30-year fixed rate on a new construction condo. I know the development, I know it can't be done, but I have to wait until they go back, and then it doesn't work, and then they come back. So I just kind of keep my file open and just wait for them to call. And I'd say about 2-3 times a year that happens.
Yeah. Well, we get people that approach us that, I'm coming in from Cincinnati. I can call so-and-so loans.
Yep.
We're like, well, you know what? Just use the local folks because they know the market. They know what's going on.
Right,
it's just, it seems like it always goes a lot smoother.
Yeah,
So,
yeah. Well, and it's funny because our out-of-state, I just started doing a lot of out-of-state loans. Our out-of-state process now for Green State is phenomenal. Used to be a little bit trickier to do out-of-state loans with Green State. We can do them now, and I'd say my experience this year, having done quite a few of them all over the country, is that we've had some pretty good success having lower rates and fees, even in some of these bigger markets. But I do get the pushback. The first call that I make is to the realtor to say, hey, this is who I am. I've been doing this 20 years. You don't have anything to worry about, because they're the same way. They're kind of nervous about this out-of-state lender, and for a good reason. A lot of those deals have trouble. They fall apart in some cases.
So history of interest rates. Just briefly talk about here over the last few years, we had interest rates 2.5%, 3%. Everybody got spoiled, and the housing market was just crazy. Multiple offers, paying way more than full price, and it's slowed down since then. But it's still really strong, and it's a great market right now. It's still steady.
Yeah,
and rates are in that 5.5, 7 range, 6, 6.5, whatever, and that's phenomenal. From if you had a history lesson, as we talked history earlier, you're probably looking at 8-9% over time.
Right.
So we're way under that.
Yeah, yeah.
So tell people who's listening, talk about interest rates over the last 40, 50 years.
Yeah, it's funny. I've got a great chart in my office that kind of shows rates. I think it goes all the way back to like the 50s, I think, like that. And it's just this arc that just goes up to the late 70s, 80s, when rates were like 16%, you know. And I'm always I feel a little better when I've got somebody that's in their 50s and 60s. Who know that like rates are, they had their first loan was 13 or 14%. So when I tell them their new rate is 6.5, they're like, that sounds great, But then I have, the kids that bought, the younger people that bought houses during COVID, when rates were, 2% on a 30-year fixed rate, and they're like 6. What is that? And I'll be honest, it's a shock, but it's amazing how quickly people kind of adjust though, and their mentality adjusts. I had a rate on an investment property that I own that just adjusted because of the type of loan that it was, commercial loan, different type of loan, but it adjusted up to like 5.875 or something from, I think it was 3.5 or something. I was ecstatic about that. But it's making it hard. I mean, it definitely changes the affordability. And then when you have prices of homes going up at the same time, it's a little bit of an adjustment for sure. But
when it was at 3%, I kept going, it's not going to last.
Right.
It can't.
Right.
And I think some of the young folks are going, hey, that's what to expect. But right now we're in what I would consider more normal times.
Yeah.
Still, like you said, if you were used to 10, 12, 13%, my first loan was a little over 9, I think, 9 and 2 points, which I could never figure out what the points were.
Right.
But you had to pay to
pay to get it. You had to pay to get that rate.
Had to pay to get it. So, so rates are great. Let's go into something else. So you learned to be a lender over 20 years. You've been a lender.
Yeah.
So we talked about Frannie and Freddy and down payments, and how did you learn it?
Yeah, it was.
Tell us more how, if you're somebody thinking about, what, I'm gonna get out and I'm gonna become a mortgage broker. Right. What would you tell somebody?
I'd say don't. No, I'm just kidding. No, there's a lot of there are young people coming in, but I was, I guess, unlucky enough. Had I started at like a Wells Fargo or something like that, the training program there was phenomenal. They flew me out to like Philadelphia and trained. So like a lot of the larger lenders, I happened to start at a brokerage that just didn't have that kind of budget, and it was sort of like a thrown to the wolves thing. But I think that was good for me because, I had to like seek out that information myself. I had to like be self-motivated. I had to learn from people on the fly. Right. I was kind of thrown into it. It's a good thing, but most of the training now is pretty specific and pretty good. Maybe not as good as I would like it to be, but it's gotten a lot better. So, for somebody coming in, new, I think it helps to get with. I think the biggest thing is probably getting with a company that already has a pretty strong reputation. I always wanted to work at Green State and at the time University of Iowa Community Credit Union because they were kicking my teeth in basically every day on deals. They were just better. People wanted to be with them, and I wanted to be there, but there's just no space for me. So I had to kind of go through this grinder, which I appreciate now. I appreciate it because I had to actually go out and sell. I had to learn to present. I had to get at bats. I had to learn how to deal with rejection, just massive amounts of rejection. Getting deals going and then have somebody leave me to go do the loan at the credit union. You talk to any loan officer, that's still a stab in the heart. Any realtor too, when you kind of do your best and then someone goes to another institution, it's still a stab in the heart for me, even now. But I eventually kind of got at bats, and I think that's what you need to be. The nice thing about like a place like Green State, and there are other institutions out there that do volume. You really need to do volume because you need to have what I call at bats. So you need to have at bats where you can sit in front of people, make mistakes, learn, make more mistakes, learn more mistakes, learn how to deal with that kind of rejection, and just keep pushing forward. And I think if you do that, it's inevitable. My boss, actually, the brokerage, ironically, he used to call it rolling the boulder up the hill. So you're just, when you first start, you're rolling this heavy boulder up the hill, and then eventually, though, you get to the top, and that boulder starts rolling down. It gets easier, and as you get older in this business, the easier it kind of becomes. And I think it's the same way with real estate. The more at bats you have, the more people the more people come back and trust you, to do what you need to do.
So in Johnson County, what percentage does Green State have in home loans?
Our market share, that's a great number for. I actually had this in our report, and I just completely forgot it. It's a decent percentage amongst our realtor partners. I think we're probably 40-50% at least, something in that. So it's pretty high.
I was going to say 40%.
Yeah.
So that's just amazing. Then the rest are just small little scraps, right? 5 to 10%.
For sale by owners, you'll have those, and then you'll have minor, smaller brokerage,
right.
Smaller shops, brokerages, and things like that. But Green State is actually the largest mortgage lender in the state of Iowa.
What kind of mortgage? What type of volume would they do in the state?
Over $1 billion.
Really?
$1 billion, which is amazing to me because I remember when we did it. I think we did just before I got here. I think it was like they crossed like the 100 million mark or something,
Crazy.
And that was insane. Everybody thought that was nuts, And I think I did just in 2020 alone, pretty close to about $186 million.
You did yourself.
Yeah, and that was an unusual year, but.
How many transactions was that?
That was it's just shy. I think it's like 880 or something like that, which
Did
is
you
too
sleep?
many.
Did you sleep?
No, I was basically working in my basement. That's the problem with me is that I don't have an off switch. So
Right, you just keep going.
Yeah, which is not necessarily always a good thing, but I'm trying to be a little more relaxed about it. And I think having lived through 08 too, having been in 08,
Right.
I don't see these mortgage crises. Everybody thinks that this
Right.
is a crisis, and maybe it is. But I've been there, done that. I don't get quite as excited about it anymore. I know that it's going to probably level out at some point, and I'm going to be ready. I've got my refi list. I'm ready to bring all these 6.5% rates down to, hopefully in the 4s or 5s again if we can get there.
So as we wrap up here today, as you look at your career, it really helped you having your little cheese stand, your Marcos.
Yeah.
I mean, you're out there, you fell down, you had your knee
Right.
scraped up.
Yep.
And you made $300 that night, but it helped you understand. And the reason why you got into lending is to make a living and try to be successful. And obviously, you're the best, I think, in Johnson County by far. But through that effort where you had to learn it, your straight commission, you have to make it happen or you don't eat.
Yeah.
Has turned you into what you are today.
Yeah,
right?
yeah, that's still that's very much it. I don't know if fear's a great motivator, but it's always there. It's always like kind of on my shoulder, even now. And my wife's tired of hearing about it every you go through the summer and it's gangbusters and you're doing great. And then the volume starts to drop off right about now, actually. And, my assistant and my wife have both become, psychologists for me, basically like therapists. And my wife has just stopped listening to it because I'm like, oh, this is finally the year. It's all over. It's all over now, And then she's like, she doesn't even listen to me anymore. She turns it off because 6 months later, I'm like, it's the best year I've ever had. It's great.
Does she do out of the family therapy? Can I talk to her?
Yeah. Oh, yeah.
Just you.
Yeah. She could probably make $1 million, but she's just going to look at you and just be like, just go to work.
Yeah. Well, it's not as cyclical as it used to be, is it?
No.
I mean, people are always getting pre-qualified. There's always stuff going on. Where there's a shortage of housing. There's a shortage of new construction.
Yeah.
I know somewhere in Cedar Rapids, it sounded like this year, a year ago, there's 1,200 listings. Now there's 400.
Right.
It's like they need housing. Where are people going to build? Where are they going to go?
That's the biggest challenge. That's the thing I think that's probably the most concerning. I hope that shakes itself out. But you have all these millennials coming in, of course, and they're becoming of age, and they're they're all buying houses, and so the demand is there, and so it's the problem is the supply is not. And I think, back in '08 had something to do with that too. And I think a lot of builders got gun shy and kind of like, I'm not going to get caught owning a lot of land, and so I understand that, but it's hard, and it makes the buying process a little bit more stressful.
Well, Pete, it's been great. And I think, if you're thinking about a young person, you're in school and you want to get to work, well, it's a great business, mortgage business, real estate's a great business.
Yeah.
And you can accomplish a lot of your goals and dreams by working at it.
Yep.
And what a better place than Iowa City and Johnson County.
Yeah, couldn't agree more.
Congratulations. Good to see you.
Yeah, you too. Thanks a lot.
Thanks, man.
Appreciate it.